Good morning. My name is Petr Georov, and today I'm going to talk about the technical analysis, focusing only on hedging. So, what is hedging? Hedging is a concept in risk management used by traders and investors across financial markets. Hedging refers to taking an additional position that help reduce or offset potential losses from an existing investment. So, the main goal of hedging is not to make profit, but rather to just reduce uncertainty and protect the capital. So hedging is commonly used in stocks, crypto, commodities, and can be also used in currencies. So especially during volatile or uncertain market conditions, hedging becomes an important tool for managing downside risk rather than just reacting emotionally to price movements. Why hedging is important? Hedging is important because financial markets are unpredictable and can change rapidly due to economic events, news, or even market sentiments. So even strong investment can experience short-term drawdowns. So hedging allows investors to stay invested while reducing the impact of these market swings. So by protecting the capital, hedging helps investors avoid panic selling during downturns. This is especially useful for long-term investors who believed in the assets fundamentals but still want to be protected against the short-term volatility. Now we have the hedging versus speculation. So we have that hedging lowers the risk, speculations increases the risks, and also different objectives. It is really important to clearly distinguish between the hedging and speculations because it's hedging focus on reducing the risk, while speculations aims to profit from price movements. So, for example, opening a short position to protect a long investment is hedging. But if you open a short position purely to profit from the price drop is speculations. So confusing these two can lead to pure decision making. Yeah. So common hedging strategies. We have diversification, we have short positions, and we also have options and derivatives. So these are several common hedging strategies which are used by investors and traders. Diversification is one of the simplest form of hedging, as spreading investments across different assets reduce the exposure to a single risk. Another strategy in short selling where an investment take a position that benefits if the price fall. So options are also widely used, particularly put options, which allows investors to protect the downside risk while also keeping upside potential. In that each strategy has different costs and also level of complexity. Now we have the hedging in practice. So in practice, hedging is used in many real world scenarios. For example, a stock investor who owns shares of a company might buy put options on that stock to protect against a potential price drop. This allows investors to limit losses while still holding the shares. Another example, a crypto investors holding Bitcoin long term might open a short position using futures contracts to hedge against short-term market corrections. So, institutional investors often hedge entire portfolios by shorting markets indicates or using derivatives to reduce exposure during uncertain economic periods. So, however, hedging is not free, option requires paying a premium, and short position can limit profit if the market moves higher. This shows that hedging is a trade-off between protection and opportunity cost. So now we have the conclusion fast. We have that the key risk is a management tool. It also protects against uncertainty and basically supports the long-term strategy. Thank you for your attention. That was my presentation. I hope you liked it. Have a nice day and see you next time.